Hey guys, good afternoon, 2:20 p.m. on Friday, July 12th, 2019. Hope everybody's doing well. It was an interesting last couple of days in the US dollar and the Canadian dollar with all the stuff going on with Jerome Powell speaking in front of Congress for the Fed, and also the Bank of Canada rate decision. And then we had some Japanese yen buying going on in today's session, so that sent some of the yen crosses down. And it's kind of a typical summertime wild swinging. So I'll probably make another video to kind of talk about some of that stuff. But this is one, just something else I'm just experimenting with. You guys, if you've been following the channel, a couple weeks ago I made a video about the definition of insanity. Doing the same thing over and over again, expecting the same results. That's an old famous saying that some people attribute it to Albert Einstein, but I don't think anybody really knows who said it, but it's still very true. And as you guys also know, if you follow my channel, traditionally I've always been kind of a hybrid trader between, say, Elliott Wave patterns and fundamentals. And I still am, and I'm not, anything that you see in this video does not in any way diminish that. But I did want to make a quick video just on some things I've been experimenting with. And in that video that I made about definition of insanity, I think I had a screenshot of a chart with the Ichimoku Kinko indicator. It is an indicator, although people kind of use it as a system. And I played around with that for quite a while, did a lot of research, did some back testing. I didn't find it to be really very useful. And it was disappointing because in hindsight, sometimes it looks good, but in reality, it's not really that good, in my opinion. So I've kind of abandoned that, but I like to always play around with other, especially indicators. Again, no indicator is perfect. There is no set of indicators that's perfect. Indicators are just tools and guides. You should never rely on them exclusively, but you know, they're pretty much all lagging. And like I said, to rely on an indicator exclusively is you're not going to really be profitable in the long run. But you know, because you have to be able to visualize the market and look at patterns and understand fundamentals, what's driving price, and just use your indicators and technicals to help you decide on entry and exit points. But you can combine them together and have a really good system, you know, and that's what I try to do. So in terms of other indicators, I found some fascinating stuff with Bill Williams indicators, and that's, you know, Bill Williams was a trader. He created a set of indicators quite a few decades ago, and you can just Google his name. You'll find lots about him. Just for the sake of this video, I'm not going to get into all of that type of stuff, but you know, you should definitely look it up. But his indicators are now pretty much part of every trading package and platform. So if for some reason you don't have it in your platform, you should be able to find downloads for them. Don't pay for them. But if you use MetaTrader 4, MetaTrader 5, which is the vast majority in Forex, or TradingView, they're all in there. So as part of the platform. So how you find them is you just this is MetaTrader 4, but it's the same in MetaTrader 5. You just go to Insert, and you go down to you go to Indicators, and then you go to Bill Williams. And the two we're going to be talking about today is the Accelerator Oscillator and the Awesome Oscillator. The other one you see on my screen is the Alligator, which I can mention briefly. That's the 3 lines. But the two we're going to primarily concentrate on are these two. And all of these are Bill Williams indicators. I don't really find a lot of value in fractals. Some people swear by them. I don't. And the Gator Oscillator and the Market Facilitation Index, I don't really see much value in either. But I'd love your opinion on it if you've ever used them. But in terms of these three, I like to play around with ones that not everybody, you know, deals with. Everybody talks about stochastics and RSIs and MACDs and TCIs and everything else. And, you know, there's probably some value to those, but I like to look at some ones that are not always talked about. And I'm also not going to get into explanation about how these are all calculated in terms of how they plot them. And, you know, although I think that's important to understand that. I'm not discounting that, you know, to know, how this indicator is calculated and then displayed. But if you just Google awesome oscillator or Google accelerator oscillator, you are going to find a whole wealth of pages that'll pop right up on the first page, and you can click on it and read a nice technical explanation about the indicator, how it's calculated, and some ideas about how to use it. But most importantly, you should just at least have a general understanding of how it's calculated. But they're all, combinations of, averaging out price over a certain number of periods and then plotting it, maybe dividing by something else or subtracting some shorter time frame of periods. So, they all have similar type formulas. It's just, they draw on different time frames and things. So anyways, so you should definitely do that before you start using these. Yeah, but I'm not going to really get into that for the sake of time on this video. I don't want to just bore everybody to death. You can look that up easily and, find out for yourself in 5 minutes. So anyways, so the two, like I said, I have on the screen here is the awesome oscillator and the accelerator oscillator. Now, just so you know, the awesome oscillator, I have changed the color to just one solid color. If you plot it on your chart default, it's going to look like the accelerator one, which is when price momentum is kind of going up. You'll see when the price, at least it has momentum going up, the bars will paint green, and that's regardless of it's above or below the zero line. So whether it's up here or down below the zero line here, if the momentum, you can see, like for instance right here, you got red, so there's downward momentum here, and then there's green, there's upward momentum. But I changed it all to one color. You can leave it as the default, or you can change it to whatever color you want. I don't care. It doesn't matter for what I'm going to talk about. I only changed it to solid color because I'm only using it for divergence purposes, and so I only need one color for that. But for this accelerator oscillator, you need to leave it at the default. I mean, you can change the colors if you want, but you need to be able to see the differences between the down momentum and up momentum. So I just left it as the default. And so this is something I'm also going to tell you that I only looked at this on the daily chart to be valuable. I did go all the way back to the 4 hour and the 1 hour, and I did a little back testing on a few pairs, and I didn't find it to really be very reliable, which is the case with most indicators. The higher the time frame you use it on, the better it's probably going to work. But of course, you won't get as many signals, though, obviously. So it probably works fine on the weekly and the monthly. I just don't trade that high up. But so I'm going to talk about the daily. But if you go and look at, like, say, a 12-hour chart, if you're using MetaTrader 5 or TradingView or something that's got more time frames than MetaTrader 4, probably would work okay there. Definitely go ahead and explore it, but I would say don't use it anywhere below the 4 hour, and closer to the daily is probably better. So for sake of simplicity, I'm only going to talk about the daily. So here's an example, guys, and this happens to be the Aussie Kiwi, and again, we're on the daily chart. And so I'm pointing to this area right here. All right. Now, what you have here is a new high on the daily chart right here. Right? It's higher than this high. It's higher than this high. Okay. But if you look down to the awesome oscillator did not make a new high. So let me put a couple of trend lines on here just so you can see. So there's the new highs there. And then if you put one here on the awesome oscillator, you see that we did not make a new high, okay, here. So we're looking at basically at this high and this high. You can't really count this one because this did not make a new high. So I don't really care about this. All right, so, but it did make a new high right here. All right, so you can see this divergence, right? Meaning the price has gone up, but the oscillator is not tracking. And so all this means, guys, is that it's kind of an early warning sign that price is running out of steam in that direction. It doesn't mean always that there's going to be a reversal. It could just be a correction, and the price might go the opposite direction for a short time and then spring back. That's when, for someone like me, I'm going to use Elliott Wave patterns and follow fundamentals to kind of determine that. But at the same time, this is a daily chart, so even if it only turns out to be a correction, temporary correction in the other direction, it still can be a lot of pips, right? Because it's a daily chart. So which is an advantage to trading on these time frames. And, quite frankly, if you're trading, multiple, if you're at least looking at multiple pairs, you can see I have like 20 something pairs I follow. You're going to find a few of these a month. You're not going to find a lot, and you got to be very consistent to the rules. But you'll probably find a few like this a month, and they could potentially be good trades, and I think there's limited risk. So we see divergence, price going up, making new highs, the oscillator not matching that. So that's the warning sign. So then you go down here to the accelerator oscillator, and basically the trading signal is to wait for the accelerator oscillator to flip below the zero line. So right here, it's still above the zero line. And there is a zero line in here, guys. I just have it turned off. Let me turn it on just so you can see what I'm talking about. You see this dotted line? That's the zero line. So anything above this is considered bullish. Anything below this is considered bearish. So you see this dotted gray line? That's the zero line. And the awesome oscillator has the same thing. I just have it turned off. Only because when you have these really small bars, it's just kind of hard to see them. So I just assume not have the zero line there. So I'm going to take it off again. I just wanted you to visualize it. You can put it on if you want. It doesn't matter. You know what it is. So, but I'm just going to take it off. Okay. So here we are back. So now what you're going to do is you're going to wait for the accelerator oscillator to flip to the downside, to flip negative. And then on the close of the second red bar, you can go short. So let me put my cursor here. This is still positive. Here's your first. Okay, so it's this bar right here is this close of the second bar, okay, below the zero line, okay? And if you hover your cursor over, you'll see it's a negative value. I mean, you can tell it's below the zero line, but if you're not sure if it's really close, you just hover your cursor over it and it'll show you the value, whether it's plus or minus. This one I wasn't exactly sure at first because it's so small, but you can see it's still technically positive. So here's your first negative bar, here's your second one. And from a trade standpoint, what candle that would be, well, since the daily chart would be at the close of the candle. All right, so it would be at the close of this candle right here, which is still green. So, I mean, that's actually a really good signal because it's not like you're waiting for like some signal way down here and you've already given up half the move. You got that second close when the price on an up day too. Okay, so you can see the accelerator oscillator is going to be, when you wait for that, is going to be behind the awesome oscillator because the divergence happens first. All right, the divergence happens here, and then it's 1, 2, 3, 4, about 5 trading days later that you got the signal to go short. So it's a daily chart. You're going to have to be patient. Now, theoretically, I'm going to tell you a more aggressive way you could trade this, but it could be more risky. Is that you could wait for the second bar of red, even if it's still above the zero line. So technically, you could have gone short right here at this bar. It's still above the zero line, though. So there's probably a little bit more risk there. And what candle would that have been? That would have been the close of this red candle right here. Now, if you had waited 2 more days, it would have been this candle, and it really wouldn't have made any difference because look how close these ranges are. The market's basically moving sideways here for a week. So I don't think it's worth the extra risk, but you certainly could do that as a more aggressive move. Want to be more conservative? Then wait for it to flip to the downside. That's your confirmation, and then wait for the second candle to close. And you go short here. And then what you do is you put your stop loss above the swing high and let it go. And you can see with this, just kept cranking to the downside. All right. So now understand again, this is a daily chart, so those stop losses can be pretty big. So if you went short here and then you put your stop up here, that's 170 pips. There's a lot of pips of risk here. So you're probably going to want to adjust your trade size accordingly. Now maybe you go to a lower time frame and find a smaller stop. Maybe you can go up here, maybe above this candle and reduce your risk. That's something you have to decide what's appropriate. But if you're going to put your stop up here, then just obviously you're going to have to go in with a much smaller trade size so you don't blow out your account if you're wrong. And then if the trade starts to go in your direction, which took a while, as you can see, went down initially, then we moved sideways for weeks. Unfortunately, this is not a good example in terms of this would have just whipsawed you around forever. But you wouldn't have gotten stopped out. even if your stop was here, you would have gotten stopped out. And eventually it broke to the downside. Okay. So hopefully, you don't have one that moves sideways for this long, but this is just an example. But you can go through your charts and find these all over the place, guys. So this is just an example I just pulled up. So, and of course, you could have rode this all the way down. This went all the way down until this flash crash on the Aussie here that happened back at the end of the year. And I remember this. All the Aussie players did this. I don't know what happened with some fat finger, and some big trader or bank during the Asian session. I don't know, but this is crazy. But that kind of brought this to an end. So that's an example. Now, if you want to talk about one to the upside, I'm going to ignore this wick. Okay, let's just ignore this one because this is obviously crazy. But let's talk about this right here. Okay, so now this is one to the upside. So here we are. And this one, you actually would have gotten a signal pretty early on the accelerator oscillator, but let's see what we got here. We have price making new lows here, okay? New low, new low, new low, new low, okay? But look at the oscillator. The oscillator is not matching that. The oscillator is continuing to make higher lows, and we get to this point right here, okay? Again, we're ignoring this wick. We get to this point right here. The accelerator oscillator at that point actually has already started to flip to green. So this is one where the accelerator oscillator is going to probably line up pretty good, but usually it's behind a little bit. So again, it flips to the upside, and at the close of the second green candle, you could go long. Now that would line up with the close of this candle right here. It's actually a red candle, but right in here. So, this happened, this initial spike up happened in 2 days. Yeah, boom, boom. That sent everything going up. Again, if you wanted to be more aggressive, well, in this case, you wouldn't have been more aggressive. This would have been your first signal either way. Now, and then we proceeded up, and from there, we went up. If you got in, say, at the close of this candle, and you rode it to the top, it's 300 pips. And this one over here, we didn't even measure, but this has got to be 500 or 600 pips if you happen to take the flash crash, which you probably wouldn't know. That's 994 pips. Even if you got out back here somewhere, it's still over 500 pips. Okay, but again, this is a daily chart, guys. I don't know if you would have rode it out this far, but you ride it until the divergence occurs again on the daily chart. Just ignore it on the lower time frames. If you took it on the daily, only follow it on the daily. Okay, and then now we're correcting again. Now, I'm an Elliott Wave trader. I'm looking at this right here as a correction. At some point, this is going to break to the upside again. I can kind of almost see 5 waves in here. I'd have to go to a lower time frame. 1, 2, 3, 4, 5. This is all a correction. This whole thing is a correction. At some point, this is going to break higher. If we take out a trend line, this is just an aside, guys. We take out a trend line right here. We get a nice break, say above this high. I'd be looking to go along this market either way. But anyways, we're not talking about that. So there's 2 examples just on this chart, guys. You can go through any pair on the daily and find this. All right. So go ahead and check that out, and be consistent to the rules, and don't take the long or the short until all things are met. So again, you look for a new high or low on the daily chart. You're working on the daily chart or higher, maybe the 12-hour. Look for a new high or low on the chart, and then look for divergence in the awesome oscillator. Okay, and then once you find that, write it down, take note of it, and when the accelerator oscillator flips the opposite way, so in the case of a downtrend with divergence, look for the accelerator flip positive, and then on the close of the second green bar, you can go long. On a downtrend, just the opposite. Okay, divergence going up. As soon as the accelerator oscillator flips below 0, divergence, take the short on the close of the second candle. Be patient. It could take days for that to happen, but be patient, and then just ride it all the way through until your whatever analysis you use, whether it's Elliott Wave or other technicals, or if you just wait for more divergence to happen again on the daily chart, and then get out at that point with your profit. Set your stop loss accordingly, either above the swing high, or if that's too much risk, either lower your lot size to something smaller, and then you can always add to your position later, or you can go to a lower time frame and maybe find a more suitable spot to put it. Like when we were talking about this, maybe you can go to a lower time frame, put it here instead of here. That still would give it a little bit of breathing room instead of way up here, but that's your decision to make. Don't blow out your account. And again, you could be more aggressive by going short. In this case, on the closing of the second red line bar, even if it's not below the zero line, probably a little bit more risky, but it would get you in a little bit sooner and could potentially reduce your risk a little bit if you can get in sooner. So that's an option too. Back test it, guys. Try it out. Anyways, I'd like to know what you guys think. Leave a comment, questions below. If you've ever used this, or if you think of any other better way to use it, I'd be interested to hear. So I hope it helps, guys. Again, it doesn't change anything I'm doing. I'm probably going to do another video on the Alligator oscillator at some point, and talk a little bit more about this Alligator, which is also another Bill Williams trend following indicator. It's kind of nice. It looks like moving averages, and basically that's what they are, but they're not calculated the same. But and there's a reason why they call it the Alligator. And again, Google it if you want to find that out. But we'll probably do another one on that. I'm still kind of playing around deciding if I like this or not, or if it crowds my charts too much. All right, but we'll talk about that another time. So that's it, guys. I hope you have a great weekend, and we will talk to everybody soon. Make sure you subscribe to the channel if you haven't already. Like it, leave comments, share it, do whatever. And, I appreciate you guys tuning in. All right, have a great weekend. Talk to you all soon.